Welcome back, everybody. Today we have a slightly different topic on hand, and we're answering the question, why are bank stocks in general performing so poorly in today's market? This video is inspired by Nirnavan4867. I'm very sorry if I didn't pronounce your name correctly, but they did leave this comment asking, can you try and explain why banks dropped down so much lately in the past month in comparison to all other sectors of the S&P 500? Now, in order to explain this, I'm going to have to go back more than a month because the problems with banks are more like a year or two old, and you'll understand why they continue to fall and why their performance has been so bad in the last couple months by understanding why they've been so bad in the last year or so. And thank you for supporting my channel. I really enjoyed digging deeper into this subject, and I hope I'm able to answer your question well. So in a very general sense, I think there are two major answers to this question. Why are banks performing so poorly? Number one is bonds. Bonds are the talk of the town right now, and they're having major effects on bank balance sheets for reasons I will explain in a little bit. And number two, general fear and uncertainty about the economy and banking. The last major economic crisis in the United States and most major developed countries was a result of improper banking, and it led to the Great Financial Crisis. It's my personal belief that there's a slight overreaction going on due to this fear that we're going to have another financial crisis, even though in most recessions, while there are banking issues, they don't tend to be as extreme as what occurred in 2007, 2008, and 2009. And so really quickly before we move on, I just wanted to show the performance of the S&P 500 Bank ETF. Its ticker symbol is KBE, and currently it is down 23% year to date. Now, if we take it from its peak at $50 in February of 2023, and we go till today, we can see that that drop has been even more extreme since the announcement of all of the banking issues and the most recent collapse of a few banks that I'll get into in a minute. But before we get into anything else, we need to answer the question, what is a bond? This is a pretty simple answer, but I don't want to skip over it in case people aren't aware because bonds play a major role in everything that's going on right now. So essentially, a bond is a loan from the buyer, who is you, to the issuer of the bond. When you're buying a bond for, let's say, $1,000, the company or country that you're buying that bond from is taking your $1,000 and promising to pay you interest on that $1,000 for the lifetime of the bond until that bond expires, at which point they'll have to pay you back for the value of the bond. Down below, we can see the market value of a bond changes over time as it becomes more or less attractive to potential buyers. What makes a bond more or less attractive? Well, number one, if the company or country that is issuing the bond has a higher quality credit rating, that means that they are more likely to pay you on time and continue making those payments over the lifetime of the bond. Some bonds are only a year or two long. Other bonds can be 100 years long. So if you're buying a 20, 40, 50, 100 year long bond, you want to know that in 50 years or 100 years, you're still going to be able to receive that payment. Due to this, bonds with shorter maturities, aka bonds that the company will pay you back in less amount of time, tend to offer lower interest rates, while bonds with longer maturities have higher interest rates due to the extended time that you are at risk of never getting your money back. So that is a quick overview. Technically, a bond is just a loan that you are giving to a company or a country. And in this case, we're going to be talking mostly about the United States Treasury bonds, which would be, in a sense, loans to the government of the United States. And here on TradingView, we can see the start of why there's a big problem going on. I have two lines pictured here. The blue line is the interest rate on a 10-year Treasury bond, while the orange line is the value of a 10-year Treasury bond. These both start on the left side at the start of 2023, I guess technically a few days into 2022. But the point is to show the year-to-date performance of both so we can understand how they interact with one another and why they're causing such major issues for banking stocks. So as we can see, the blue and orange lines are what we would consider to be inversely correlated, meaning when the blue line goes up, the orange line comes down, and vice versa. Recently, we've seen a major rise in the blue line, which is the interest rate paid on bonds. That is due to the Federal Reserve of the United States, which continues to increase interest rates in order to slow the economy and try to stave off inflation. With that rise in interest rates, we've seen the value of the 10-year bond go down. Now, why does the value of the bond go down as interest rates go up? It's because if you were to go to the open market and ask to buy $1,000 of a 10-year Treasury bond, let's say, and the government is offering you 3%, you give them $1,000 and the government's going to pay you $30 a year for 10 years. When the government increases that interest rate to, let's say, 5%, now any bond that you buy on the open market from the government is going to give you $50 a year instead of $30 a year. So in order to sell bonds that you already have at a lower interest rate, you need to sell them for a price that allows the buyer to receive an interest rate similar to what is available on the open market. So if interest rates are doubled, the value of the bond that you hold is roughly cut in half in order to make the effective interest rate of the bond similar to what you can buy on the open market. I hope that all makes sense. Bonds can actually be incredibly complex, so if you want to look more into it, I'll let you do that on your own. But for now, we're going to move on to talking about where the problem has arisen and where we're going. As you can see in this article, the bank became insolvent very quickly over the course of just a couple days in 2023 as depositors continued to pull their cash out of the bank, forcing the bank to sell its treasuries and essentially lose all depositor trust. Now let's break this down a little bit. Silicon Valley Bank in particular held a lot of deposits for startup companies. The unique thing about startup companies is that they do not have a lot of cash consistently coming in. Instead, they go with rounds of investments where people can give them usually millions, tens of millions, hundreds of millions, even potentially billions of dollars, depending on how valuable a startup may be. And they're given all of this money at one time, and then that money is stored in a bank like Silicon Valley Bank, and it's held onto and slowly used over time as the startup needs it. So what a bank does is that when they receive the money from their depositors, that cash is initially held on the balance sheet as a liability. I'm going to denote that as this green bar right here to represent the money that the depositors have given the bank that they hold on to. Now, what Silicon Valley Bank and other banks do is they take that money and they hold on to some of it due to requirements of US law. So that'll be denoted by this smaller amount of money that they're holding on to. Then they loan out a significant amount of those cash deposits to create money, which is why this red bar is immediately higher than the green bar. It's called fractional reserve banking. I'm not going to get into it, but it's how money is created in our system today. And it allows banks to loan out more money than they actually have. And finally, there's a little bit of money that the bank will hold on to in different treasuries and other forms of collateral, which include US bonds. US bonds are considered very safe collateral because the United States government is effectively the most powerful government and economy in the world. And so if they default, then the rest of the world is also going to have major issues. So they're kind of the most important lender and the only game in town for most banks, at least in the United States. What's also significant is that the portion that's kept on the balance sheets at banks like Silicon Valley Bank that are held in treasuries pay a higher interest rate to the bank than what the bank pays to its customers in order to hold on to their money. So if the bank is receiving 4% per year on the bonds that they hold, they might be paying their customer deposits 2% per year, which leaves them 2% left over that is pure profit. And that's a major part of the bank's business model. What happened in Silicon Valley Bank is that a number of the depositors decided to start pulling their money. Now, when a depositor pulls their money, that essentially cuts off the amount of money that Silicon Valley Bank has and leaves just a little bit less on their balance sheets. So in order to give their depositors their money immediately, Silicon Valley Bank is going to tap into this amount of cash that they keep on hand to pay off those depositors, which makes the cash that they have on hand suddenly less than the amount that they need by government law in order to keep the bank in a quote unquote safe position. So what Silicon Valley Bank and other banks might do is they might sell some of their bonds that they hold and turn that into cash in order to make up for the difference. So suddenly they hold less bonds and are making less money, but they still have all the cash they need, right? Well, usually yes, because we don't see depositors take a ton of money very quickly. But in Silicon Valley Bank's case, more depositors decided to pull more money so that now they have even less cash on hand and they have to sell even more bonds to keep more cash on hand. And the cycle just continued to repeat itself over and over and over. Now, depending on the financial conditions of the economy that this is occurring under, this actually might not be the worst thing in the world. But if we think back to the Treasury price graph that I just showed earlier, the 10-year Treasury and all other Treasuries that the United States has offered have gone down and down and down in value over time due to rising interest rates. So what happened was that Silicon Valley Bank bought these bonds at a price up here and then had to sell these bonds at a price down there. And this gap in prices became a loss that the company had to sustain off of its own balance sheet. What initially started as a small loss began to grow to a bigger loss and a bigger loss and a bigger loss until eventually the bank could not handle any more losses and it had to be closed by financial regulators in order to avoid losing everything for everybody. We would see this run on banks happen to a couple other banks that had similar business models, most notably First Republic Bank. And everything that happened in March is continuing to reverberate throughout the financial system today. We can see those reverberations in this series of charts right here. Before we get too into this, I want to say that on the left side are two candidates that represent the largest banks in the United States. These are what we would consider structurally significant banks that cannot go bust. In the eyes of most people, these are the safest banks to have your money with and be invested in, so they're in green. In the middle, we have what I would call super regional banks. These are banks that aren't as large as the most structurally significant banks like JP Morgan or Bank of America that are shown here, but they're very, very, very economically important in the regions they operate in, and they're essentially like a too big to fail bank, but for specific regions of the United States. I have these two examples in orange to show that they're not exactly a green light or the best, safest investment, but they're also not as risky as the investments to the right-hand side, which are in red. Now, these red banks signify the smaller regional banks that typically serve a very specialized customer base or a very geographically small segment of the United States. These are considered the most risky banks because they tend to have a lot less buffer in their capital requirements, and they have less strict rules about how they use their capital, so they're more likely to misuse their funds. And so to explain the bar graphs, each bar represents a year, 2018 through the trailing 12 months, and they show the total amount of customer deposits on hand at each bank. On the left-hand side, we can see JP Morgan and US Bank have grown steadily through 2021, and since 2021 are down slightly. JP Morgan down 3%, Bank of America down 9% in deposits. Now, there are a lot of reasons for deposits to rise and fall, but typically we do want to see deposits rising because it gives the bank more financial freedom to operate their business however they choose to. In the middle, we see Truist Financial on the top, which had a big jump through 2021, but has held on to most of its deposits since and is currently sitting at 4% below its peak 2021 values. Below it is US Bank, which is sitting 14% higher than its 2021 value, but has dropped in the trailing 12 months versus 2022. And then on the right side, we show PacWest Bank or Pacific Western Bank, which has dropped by a whopping 24% in its deposits from 2021 to the trailing 12 months. And below it, Eagle Bank dropping 16% in deposits from the 2021 to the trailing 12 months. So the first question we must ask is, why are the smaller banks seeing much greater drop-offs in their deposit rates versus the larger banks? And I think that's generally answered by asking yourself the question, where would you keep your money? If you just watched a smaller regional bank lose all of its money, not technically lose, the government guaranteed those deposits. So you did keep your money even though the government had to kind of bail it out for you. But would you rather keep your hard-earned deposits in a bank that is more likely to fail, like a smaller bank, or would you like to go to one of these massive banks like Bank of America or JP Morgan where the government literally will not allow them to fail and keep your money there? You might earn a little less interest at these larger banks, but your money is definitely much safer. And so that's the trend we're seeing. We're seeing consumers take their money out of smaller banks and put them into larger banks. The same for businesses. They're doing the exact same thing. They're moving from smaller banks to larger banks. They're foregoing a little extra money earned from interest in order to keep that safety and to keep that general peace of mind. But deposits are only part of the bond story. And to get into the even scarier part of how risky banks might be looking right now, I need to talk about bank accounting. This is going to get very technical. I'm going to do my best to try and simplify it for you, but this will have a few different acronyms and things that you're going to have to keep track of in order to really understand what's going on. So I found this great scientific paper called Banks' Motivations for Designating Securities as Held to Maturity. And this was released just about a month ago from researchers from the Columbia University, the City University of New York, and New York University. So to Professors Kim, and Ryan, I greatly appreciate the hard work that you did creating this. There's a lot of great information. If you do want to get really in depth on all of the issues surrounding what we're going to talk about, the held to maturity versus available for sale, this is a great paper to look up. So what is the difference in accounting between held to maturity, or HTM, and available for sale, AFS? To try and put it as simply as possible, held to maturity means that the bank has bought a bond and plans to hold it until that bond expires. That bond could expire in 5 years, 10 years, 30 years, it all depends on the bond. But the bank has no plans on selling that bond. Conversely, available for sale means that that bond is sitting on the books as something that the bank is willing to sell at any time. If you gain nothing else beyond what I'm going to explain about these two, held to maturity should be considered a lie. It is an absolute lie. It's an accounting trick. And down at the bottom of the abstract, we can see that the authors of this paper even support recent calls to eliminate the held to maturity category as a possible accounting trick for banks to use, because it is such a serious and for all intents and purposes, it's stupid. It's a stupid lie. So while we consider HTM to be a lie, we can also consider available for sale, or AFS, to be a truth, or at least better than held to maturity. It's not entirely a truth because not everything in the bank's accounting shows up as AFS because they're hiding a bunch of it in HTM. But what is an AFS, what is marked as available for sale, does represent the actual value of what the bank is holding on to. So how does the difference between HTM and AFS change how a bank's assets and balance sheet look? When a bank marks a bond as hold to maturity, that bond is kept at the value that it was purchased at. So if you bought a bond for $10,000 and then interest rates go up, meaning the value of that bond falls, and now that bond is worth, let's say, $5,000. On the open market and in honest accounting, this bond is worth $5,000. But because the bank has it listed as hold to maturity, eventually, as long as they hold on to that bond for long enough, they will get their $10,000 back, and the bank considers that bond to be worth $10,000. Now, let's talk about a more real life example so you can kind of understand what we're actually talking about here. If you bought a car for $10,000, you kept that car for 2 years, you drove it around, it's still in good condition, it's fine, and you bring it back to the place that you bought that car from, what are they going to tell you the value of that car is? They're not going to tell you it's still worth $10,000 because you paid $10,000 for it. They're going to say, no, that car is worth $5,000 now because you've driven it around, there's newer models out there, there's better products available for people, there's less interest for that car, so it's only worth $5,000. Is any car company, car lot going to buy your car back from you for $10,000 because you paid $10,000 for it? No, they're not. That's not how the economy works. But these banks have created an accounting trick that lets them basically say, well, yeah, I bought it for $10,000, so it's still worth $10,000, no matter what you say. If I go onto the open market, I can only sell it for $5,000, but to me, it's still worth $10,000. You as a consumer could never, ever, ever do that, but banks do it all the time, and they're increasingly doing it more and more to hide the losses that they are getting from their bonds. On the other hand, in the available for sale bonds, if they bought $10,000 worth of these bonds and the value of those bonds fell to $5,000, if they are still listed as available for sale, which the bank can change where the bonds are listed as either HTM or AFS at any time, so they cheat that way too. But if it is still listed as available for sale, that is only on their books as being worth $5,000, aka the honest, true, real value of that bond. This is why I said available for sale is true and it's honest, and even though they can switch between being available for sale and hold till maturity at any given time, what is showing in available for sale is an honest reflection of the value of those assets. Anything in HTM is a complete lie, and they do it to hide any sort of capital losses that they have on their books. And so I'm sure many of you who are listening have already figured out what happened to Silicon Valley Bank and how this could come back to really bite any other bank. What Silicon Valley Bank had to do is move out some of its assets that were in the hold to maturity and send them to available for sale. Why? Because they were forced to sell these assets. And when you're forced to sell these assets, it doesn't matter what value you think it's worth. That's all crap. This is the value it's worth. That's the money you're going to get on the open market, and you're going to lose $5,000. Many people in the stock market and individual investors like to have this idea that banks are smarter than us and they make all the right decisions and they manipulate everything. In reality, they just have a lot of lawyers that come up with a lot of tricks. They are not great at investing, and many banks invested heavily in U.S. Treasury bonds during the COVID crisis when interest rates were basically 0%, which means that the value of that bond is basically as high as it will ever be. And as interest rates have continued to climb, the value of those bonds continue to fall. And so the amount of money that they're hiding in this HTM category isn't just $5,000, it's now $8,000, and then it's going to be $9,000, and eventually there is the possibility, although it's highly unlikely, but there's the possibility that these bonds just become nearly worthless. Obviously, they're not nearly worthless. They never will be nearly worthless unless the U.S. government defaults. That's a totally different story. But they have lost significant levels of cash. And so in these figures, this is just going to show you how the different banks have chosen to go about this, right? So in this chart, we can see the transfers from the available for sale category to the hold to maturity category. Essentially meaning, hey, we're going to stop keeping track of what these bonds are worth, and you're just going to accept that these bonds are worth exactly what we paid for them, which, let's call it out, it's BS. But what do you know? The banks do it anyways, and look at this massive increase in the amount of bonds sitting in hold to maturity. But I don't want to give the banks too much bad rap, right? I mean, they do move things from hold to maturity to they're available for sale occasionally, right? And that's absolutely true. They do that only when it benefits them. So when interest rates were going higher and then they went low again, then the value of those bonds increases significantly. And boom, look at that. We're going to change everything to available for sale again. So that way our balance sheet looks really good. And then, oh, interest rates are rising again. Shoot, looks like we're just going to hold on to these bonds and pretend they're all worth the same amount of money as they used to be, even though they are not. In this chart, I want you to pay attention to the line graphs here, little dot line graphs, as well as the gray line right here. So what we can see is that the gray line is the 3-month treasury rate, essentially the current interest rate of the economy and the percent that you can get with a new treasury rate. And as we can see, as that gray shaded area goes up over time, the amount of available for sale securities as a percentage of total assets goes down. So if interest rate goes up, then available for sale goes down. We just got done looking at this relationship, but you can see that over time, even since 2012, the general consensus has been less and less marked as available for sale because interest rates have been falling generally. And then when they rise back up, that makes the bonds that people have been buying for the better part of a decade now worth less. And so we want to hide those losses, right? Typical banking stuff here. This chart then shows the opposite, the amount of hold to maturity securities as a percentage of assets. So as interest rates rise, we decide to hold more and more of our bonds to maturity because, hey, they're worth nothing, but let's pretend they're worth a lot. And then all of a sudden, interest rates come down, our bonds become worth a ton of money, and bam, we're going to send all of these to available for sale because now they're worth so much money and look how good we are at investing. And then as interest rates continue to climb, we're going to pretend again that, hey, we don't actually own these bonds that are worth less and less money. They're just being held on to for now. So it's different. Trust us. And so then in this final chart, we can see the total number of hold to maturity securities divided by the sum of available for sale and hold to maturity securities. So essentially, what percentage of their total securities that the banks are holding on to are they marking as available for sale versus hold to maturity? And so the higher this number is, the more they're holding to maturity and pretending that it's worth something that it's not. And as we can see, since 2012, that number has steadily increased, where for some banks and some institutions, we see a number as high as 60% of their total assets being held to maturity. And then final graph, I promise, this is showing the extent of fair value hedges against fixed rate available for sale securities. Now, what makes that interesting is that when something is available for sale and hedged, that means that the risk exposure of the bank is lower because they've hedged it, right? They might still lose money if something drastic that they didn't plan for happens, but they will not lose as much money because they are prepared for that event. And what we can see is that one category of bank is rocketing higher and is able to hedge much better than the other two categories, which are basically just sitting at zero and not hedging at all. So who is this AA bank category? These are your super majors: Bank of America, JP Morgan, Citigroup, Goldman Sachs, all of the largest banks. It makes sense that they're able to hedge because they're just much larger players. They tend to be more sophisticated, and so they have more ability, more capital, and more knowledge to be able to make these hedges, whereas our smaller, more regional banks just don't have the bandwidth for that, and they're going nowhere. They're not protecting their risk at all. And so that is why we've seen larger banks, although they're still suffering, they're not suffering as much as the regionals, and especially the really small regional banks. And if you were interested, that AA category that I showed earlier that's actually hedging quite well, these are the banks that fall into that category. Then there's the opt-out category, which if you want to go back and look at things, they're kind of a special category of bank that's in between these massive super majors and the smaller regional banks. So they're listed right here. And then every other bank falls under the non-AA approach, which is, just the smaller guys that don't have the capital, they don't have the human talent or the experience to manage and hedge quite the same as these larger advanced approach banks. And so that is in a nutshell why banks are performing so poorly today. There is a lot of fear and uncertainty about the economy, about the consumer. There's a lot of previous pain involved from the global financial crisis, which was our most recent major economic crisis. But essentially, this all falls down to bonds and how the U.S. interest rate is continuing to climb, which is causing more banks to hold their collateral and their bonds in this hold to maturity category, which is, as we stated, the lie category. It's not real. The value is totally fake. And when they do this, essentially their books look so much better than they actually are. And there's the fear that a bank like Silicon Valley Bank is going to have to take bonds out of their HTM category and set them as available for sale because they will be forced to as consumers take away their deposits or lose their deposits because they don't have a job and they need to keep spending money and paying off their mortgage and things like that. So this is kind of a grave that the banks have dug themselves. There was no reason for them to invest so heavily into U.S. bonds, especially at a time when interest rates were zero, and the only logical direction for bonds interest rates would be up, and therefore bond values would be down. They still bought billions of dollars worth of these bonds, and they did it because they wanted to make an extra 1 or 2% on the money that they held on for people. It's a story of greed. Welcome to the financial world. But I want to end with some, I don't know, let's call it okay news. And here is that okay news. The Federal Reserve, in a reaction to the Silicon Valley Bank collapse, has created a new liquidity backstop to stop contagion fears. Essentially, they want to make sure that people know that banks are safe, and that's a good thing. They created a program that will essentially take any bond from any bank that needs to sell these HTM assets, and they'll pay them at face value for the bond. So even if the bond, this $10,000 bond, to use our example, even though it's worth $5,000, the Federal Reserve will give that bank $10,000 for the bond in order to make sure that the banks can pay back their consumers. This is great news for consumers who definitely don't want to lose their deposits, their savings, and a lot of, their life's work. But it's also perpetuating the exact same problem that got us into this issue. I'm not going to say this is an easy decision or that what the Fed did is wrong, but it's certainly exacerbating a problem that is only going to be allowed to continue without further banking reform and banking regulations. But with that, I will leave you to your own opinions on if or when or how those should be done. Thank you so much for making it through this video. I know it was a little bit different than what I usually do. Hopefully you made it all the way through. Hopefully I didn't confuse you too much. But let me know what you think. Are you interested in buying bank stocks right now? Or does this whole hold to maturity and available for sale stuff make you want to sell all of your bank assets, or at least not get into the banking investing at all? Thank you so much for your view and for your time. If you do have a second, please like the video and subscribe to my channel. It means a ton to me. And with that, I hope you have an excellent day. Thanks, guys. Bye.